Okay? Now, you see the first hand. No. Yes. First handout you see with you. Any confusion? I don't think there should be. Please ask me. Huh? Illustration 1, deferred tax liability recognized in profit or loss.
Last year the deferred tax expense is adjusted with current tax. The last year the deferred tax expense is adjusted with current tax.
Last year deferred tax liability first 4 years we have created 2 rupees, 2 rupees, 2 rupees. Last year it is reversed. You see the journal entry at the bottom. This ledger accounts in T form. I mean this running balance format. You can see the journal here. First year entries, deferred tax expense, debit to deferred tax liability 2 rupees. Same thing for the 4 years. And last year, I am having a balance of 8 rupees as deferred tax liability, which is reversed by debiting to PL account. Last year, deferred tax liability debit to tax expense. Current tax calculation is different. This is just the basic, I tell you. This is not what you do. This is the basic concept you have to do in block of assets for income tax purposes. And here you have to follow this IS 16. You can follow these 3 methods, straight line, divisible. So there you need to calculate. This is the basic thing I am giving you just. Opposite is illustration 2. Next, So far as what we are doing is deferred tax arising out of PL only. Okay? Now deferred tax in other comprehensive income. What is other comprehensive income? That the transaction does not affect my accounting profit. Good example is what? Revaluation profit on PPE or investment in equity instruments. So if there is any fair value change, it will not affect my PL. It is only the balance sheet item. See this example? Yes, please.
In AS 22, in the second scenario, we don't account for this deferred tax asset.
Huh?
In AS 22,
AS22 I cannot say. This is OCI. AS2 doesn't cover OCI. One thing I tell you, this is my, I do not know much of AS. That's blessings for me. So anywhere I go, people tell me what is the difference. But IFRS learning, the first condition what I personally feel, it is unlearn and relearn. It is very easy to relearn but very difficult to unlearn. If you ask me, think of your father, keep your eyes shut, yes I can think of my father. But if you ask me now, don't think of your mother, I can't do that. So please, what is there you forget, look forward. Because it is the differences, I blame in chalk and cheese. If you tell me what is the difference in AS1 and Ind AS 1, two different things. AS1 is what? Disclosure of accounting policies. And here, it covers separate financial statement, it covers consolidated financial statements, 24 to 35, 10 paragraphs covers only your interim financial statements, not meant for short-term preparation of, balance sheet. What you provide some bank, no, it is for general financial statements. It involves income tax, it involves everything. So OCI concept was compared even in revised schedule 6. So here the thing is what? The right hand side value increased by the increase in the left hand side what I put. That one reserve net of tax, because the reserve will go straight to my retained earnings. Any retained earnings have to be after tax. And deferred tax liability will be adjusted. So I am setting aside from my profit that I know that if I earn 30 rupees, I need to pay this much of tax. Set aside, remaining will go to retained earnings. This needs a lot of practice, I tell you. Again, I reiterate. Can I go ahead? Can I go ahead, sir? Yes. There are certain new things. You see, balance sheet records what? Assets and liabilities. Those assets are not assets on the balance sheet day. They are future assets. They will provide me economic benefits in the future. Liability is what is the obligation on the balance sheet date. It is my future obligation. There are many things coming convertible bonds. This is the example. Simple thing is, I have received how much? 1000 rupees. What is my obligation today? I will make interest payment plus the principal conversion. What is the present value today? 875. So 125, 1000 minus 875 is my profit. Equity portion of convertible bonds. See, if I have profit is 125, income tax it is 40%, so it is 75 and 50. A an item is called financial liability when I have some contractual obligation to make payments. I have contractual obligation to make payments of interest how much? 50-50. Another 50 and 1000 rupees conversion. So my liability today at present value, this Minaji, what you taught you that fair value is 875. I have received 1000. So why I am giving you 5%? Because I give you a bonus. After 3 years, your bond will be converted to this. So without this conversion feature, the market rate is what is called effective interest rate is 10%. Absolutely new thing. Same thing might happen for preference shares. Now preference shares can be your equity, preference shares can be your liability, it can be both. Suppose I am issuing one non-cumulative preference shares, say 5 years. Okay? There is no guarantee I will pay. I get today 100 rupees. Okay? There is no guarantee I will pay you any. So I redeem after 5 years. Okay? Any dividend if I pay, that is part of coming from changes in equity deducted from retained earnings, not affecting my profit or loss. So what is the value today? Much less than 100 rupees. Extra thing is equity portion, that is my income. Net of tax will go to my retained earnings when the shares are redeemed. Here 75 go where? Retained earnings. And 25, 50 will be adjusted against my tax liability. So one important thing I tell you, that one deferred tax liability having 3 columns. Main I told you yesterday, day before yesterday suppose. Main thing is devil are all in details. Anywhere you see. The moment you go deep into this, you will find all devils. The moment you go through one standard, then you see the disclosures. The moment you see the disclosures, you will appreciate how much amount of labor energy put into that and how much you have understood that standard. They will say you make a disclosure. Deferred tax liability account will have 3 columns. One, deferred tax liability through PL, deferred tax liability through OCI, deferred liability directly in equity. First transaction affecting my PL, second transaction affecting my OCI. So anything coming in OCI will come also change in equity also. Revaluation surplus, net of tax. OCI is always net of tax. Probably paragraph 90, I think. In this one, can you check out? Yes. See this? This is not income tax standard, Index 1. Don't get scared. Everybody will find IFRS examples ignored, deferred taxes. For simplicity, deferred taxes is ignored. But you cannot avoid. See? When you prepare OCI immediately after profit and loss, it is other comprehensive within bracket, net of income taxes. So deferred tax liability will have 3 columns, deferred tax asset will have 3 columns. Arising from PL, OCI, arising from directly changes in equity. Next one. amount deductible is the intrinsic value, what benefit you are giving. But you can debit your PL. This is, this you have to realize. This you have to realize. I don't expect you to learn. Yesterday I gave you an example about Yudhishthira and this thing. What is the moral of the story? What is the moral of the story? Did you recall what I told you yesterday? Yudhishthira, Satyam Vada, Kradam Makura, always speak the truth. What is the moral of the story? There is enormous disconnect between understanding and doing. We understand many things, but we don't do. We don't do what we believe in. We do only what is convenient, and thereafter we repent. So IFRS is something that need realization, to realize what the thing is. You go to any gym, you will find top executives, middle-aged, out of shape like me, listening to the instructor. Will you be surprised to see them unchanged after 1 year later? You will see the same as it was. Why? Because the source of physical fitness is not understanding the theory of working out. It is getting yourself involved in regular exercise. 6-pack, 6 well-developed muscles. Not for you, ma'am. They will not grow one by one. They will go together. Regular exercise, proper diet. Shahrukh Khan will have 6, Amir Khan will have 8-pack. Now somebody will have 10-pack, something like that. So here the thing you have to realize what the thing is. Share-based payments say you can debit only the fair value, but deduction is what? Deduction is the intrinsic value. Yes, 10 rupees share, market price 50 rupees, I am giving free to them. I must have deduction of 50. If I can sell this in the market 50, I am giving to my employees. But I am debiting only the fair value. Balance from what I will take? I will take from retained earnings. What is the problem with retained earnings? It is already net of tax. See, if I have to take 20 rupees from that, I have to give you 100 rupees. So already it is net of tax, so I can take only 12 from that. See this entry. So far as what we have done is just basic, I tell you. Ultimate accounting is consolidation. Remember, Ind AS 1 is not for separate financial statement. It is also for consolidation. And you will find tremendous thing written on that. Effect of taxation when one company takes over another, this business combination. Next. You ask me what is the meaning of taxable temporal difference, what is deductible temporal difference. Language is very tough, double Dutch, not unequivocal. See this language, are you happy with this? Is this language clear? What is taxable temporal difference, deductible temporal difference? Is this okay? Scenario 1, current tax you blindly copy, okay? Then see revenue, what happened? Which one? We getting revenue 100, 120. Which one? Taxable or deductible? Revenue recognized not taxable or revenue taxable not recognized? Which one? See this language, in a very simple it is written.
Revenue recognized but not taxable.
Understood? Should I explain? Huh? Huh? See this? Revenue is what? I have recorded revenue 100 rupees. Income tax says no. Because 20 rupees I have separated, revenue received in advance. So my accounting profit there is only 100 rupees. But they say no, you have to pay on entire 120 rupees as this. So 20 rupees extra is what? Deductible or taxable? Huh? Taxable. So what is the amount? We want this to 120 minus 100 is 20 into 40% is 8. What is that? Is this income or expense? Income. What about cost of sales? See this. Expenses charged but not allowed, or expenses allowed but not charged. Which one? This you have done in your BCom even, I suppose. Profits and gains of business or profession. Cost of sales I have charged more or less? Less, so?
Expenses deductible.
Yes, that's a liability. They are allowing me 90, I have charged only 80. Say 10 rupees, 40% is 4 rupees. Deferred tax liability. So this tax expense becoming on actual basis. 40% of 20 is how much? 8. Scenario 2 you see? Nitish, time? Huh? Hai, 10 minutes hai. Can I go ahead? Huh? Okay. Case 2. Accounting profit sale is taxable income. Taxable profit, no. So no current tax payable. That means what? I create what? Deferred tax asset. I have suffered a loss. They say that it is a loss. So I charge one deferred tax asset of 8 rupees. And thereafter what happened? Your revenue 100, they recorded 80. 20 rupees is what? Taxable or deductible?
Taxable.
Yes. And cost of sales 80 and 100? Taxable. So 8 plus 8, 16. You see 16 there. 8 rupees charge, 40%. Year 2 you see. Scenario 2, not year 2, sorry. Scenario 2. Accounting profit loss, taxable profit gain. Current tax I pay 8 rupees recorded, and difference between 80 and 100, 20, and 100 and 80, so has to be 16. explain? I'll go ahead. Go ahead, thank you. Case 3.
How is the current expense 16?
Which one?
Case 2.
Case 3.
Yes.
Case 3. Just a minute. हाँ बोलिए जी क्या हुआ?
16 how we pay it?
16. Current tax. There it is.
Scenario 1.
Scenario 1, no current tax.
Deferred tax expenses liability 16.
Difference 180, 80 and 100 you see. What is 80? It is deferred tax asset for the loss suffered. Because in future I will be allowed to recover that. Next year I recovered this. I am cancelling my deferred tax asset. What? I can create one asset by suffering loss. Imagine what is accounting.
How is 16?
16 you work out, you see what is the difference in sales and difference in cost of sales.
Please explain the table. This is not
Year 1, okay. Year 1, my accounting profit is 20 positive, but as per income tax, 20. That means what? Henceforth, next time when I will make profit, this will be adjusted. Yes or no? For that I create one deferred tax asset. That this you know, I suppose. Yes, 22 must be there. There is one condition. Because the moment you record one deferred tax asset, that means what? You are doing something what is called anti-conservatism. Yes or no?
Yes.
You are showing less profit. Peculiar enough, just by incurring my loss, I am creating one asset. So there is an alarming indication that you will have to be virtually certain that see it. Next year, this year something has happened, I am not very sure. Next year I will be earning some profit that will recoup my loss. So I am allowed to do this. What about the balance 16 rupees? Year 1, my revenue 100, revenue 80, 20. This 20 is what? Taxable or deductible? Taxable. And 80 rupees and 100 rupees? Add up these two, how much is coming? 16? Yes or no? So this is 8 rupees. Next year my current tax is 16. That 8 what I have recorded is reversed in the next year. I am recognizing deferred tax asset what was recorded earlier. And balance is also 16 you see. 130, 150, 110, 90. It is taxable or deductible work out. सर थोड़ा टाइम लगेगा फैमिली स्पीकिंग ये माने फैमिली स्पीकिंग It's a huge thing, man. I really appreciate. Huh? Which 16?
The deferred tax expense is not clear.
Year 1 or year 2?
Year 1.
Year 1. Difference between sales 180. What it is? Deferred tax liability, deferred tax expense. Go through. At the bottom it is given taxable or deductible. You go through this. Go through this. It is given. Is this taxable or deductible? So deferred tax expense, and then your cost of sales 80, and they have deducted 100. You have deducted much. That is also deferred tax liability. Remember, if you charge less expense than what is allowed, it's deferred tax liability. If you charge more expense than what is allowed, it is deferred tax asset. Acha, race thing time will not permit. You just go through tomorrow. I think I have 2 sessions. So I'll be clarifying. Now can you just have a look at Index 16?
Illustration 5.
Illustration 5. Revaluation? Is this revaluation of PP? Lesson 5? So when one asset is revalued, there are 6 adjustments. What is the first adjustment? Asset value is increased. Okay. Now first thing I tell you, this seminars like this, people ask me, sir, we are not going to devalue any assets, so why do we need to learn? First question they ask, we are not going to devalue, excepting for land. Thing is, if you do not have this concept, you forget about consolidation. The moment you talk about business combination, everything is fair value. Any asset you take more than its carrying amount, entire value of goodwill will depend on how much deferred tax liability, how much of the asset you have created. So you need to have knowledge of all this. OCI, you cannot avoid 2 things. First is your employee benefits. You cannot avoid your leave encashment and gratuity. Can't avoid. हाथ पे हाथ खड़ा आ जाएगा. And second thing, you must have some investment in debt or equity instruments. Both 2 will come. And if these 2 come, you have to have one statement of changes in equity. There you have to have share capital, have to retain earnings, and at least these 2. So we need to have thorough knowledge over this. Because assets, liabilities will all be taken over at fair values, maybe more than this. Sometimes one asset will be taken over which does not exist in the books of the subsidiary. It does not exist. They have spent huge amount of, on research, everything written off, value is 0, but you can put a value there. One more alarming thing is, क्या बोलेगा आपको सर? My friend called me to one restaurant. The moment I entered, I could make out it is not a restaurant, it's a bar. मेरा कुछ problem है. I can't just put up with the smell of all this. Anyway, I am unfit. So I was waiting. Friend was not there. बोले सर क्या लीजिएगा? मैं ठीक है चलो एक तो फ्रेश लाइन छोड़ा ले भाई, ला फ्रेश लाइन छोड़ा, कुछ बादाम ले आओ. The thing was served immediately. The bill was placed. I looked at him. बोले क्या बात है? बोले pay this. बोले बाप रे, बोले पीने दो. बोले no sir, clear your dues. Indirectly, what you wanted to tell me, before you get drunk, you clear your dues. So there I remember this income tax. Government share बेचेगा ना बेचेगा, I transfer to OCI, I set aside income tax liabilities. Now, when you revalue an asset, there are 6 adjustments, very dangerous thing. My asset value going up, number 1. Number 2 is what? There is one reserve, fair devaluation surplus. Third adjustment, revaluation surplus will come in OCI net of tax. That means I am creating one deferred tax liability which will be a non-current liability. Deferred tax liability assets are always non-current. Because you do not know, deferred tax liability, remember, if it is in PL, it is reversed. It is in OCI, it is de-recognized. So third adjustment is deferred tax liability created. What is the effect? My profit will go down because of extra depreciation, yes or no? Huh? Profit will go up? Tax expenses? Go up. Last is what? Revaluation surplus, what is there in the equity, that will go to my retained earnings. So one asset will have how many columns? You just see what is given in second page, illustration 5, you see. One is gross carrying amount, one is revaluation surplus, one is accumulated depreciation. Then what is the tax base? What is deferred tax liability? What is the original cost? Imagine just one single asset. Now when you prepare your fixed assets chart for your company, and when there is block of assets, imagine what will happen to you. I have no idea, sorry. See the screen. How does it look? One thing you remember, paragraph meaning you must know. You need to explain either to your boss or to your subordinate. Oh, sir, to aata nahi hai kuch. Don't give this chance to your subordinates. Okay? That has a reference in your financial statements. Each and everything given as per paragraph reference. Cash and cash equivalent, what I'll tell you, in the cash flow and cash in the PL and balance sheet, these two figures are the same. In theory, everything is very, very simple. But in practice, it is very, very difficult. What is possible may not be probable. So one asset, can you imagine this? Think of that asset register that you need to maintain. For how many years you need to keep? So see, this is already 8:36. Go through this, tomorrow I am here, okay? And any queries, you just send me an email, no problem.
We had also given one feedback form for the speaker, so if you can just fill up and give.
Yes. Feedback form is very, very important.
Before we sum up, we are very thankful for Amitabh Mukhopadhyay ji, who has shared the valuable knowledge with us. I request everybody to put your hands together for the learned speaker, please. And I request Vasant Parak ji, please come forward and offer a memento on behalf of all of us to. Is there? Yes. Just 1 minute for the learned speaker.
It all depends on your sincere desires.
He is very yes. We will try to arrange the additional screen. I had already talked with one vendor also right now.